The dollar crashed 41% between February 2002 and April 2008, with the dollar index falling from 120 to 71. In 2025, a new dollar crash is underway. The dollar index has plunged 10% since its most recent peak on January 13th this year. This video will compare the dollar crisis that began in 2002 with the current one. It concludes that the dollar crisis of 2025 has only just begun, that the dollar has much further to fall, and that the negative consequences of this crash could extend far beyond the financial markets. Last time, the dollar index fell in two stages. During the first stage, it dropped 33% between February 2002 and December 2004, from 120 to 81. A number of factors converged in the early 2000s that caused the dollar to begin falling sharply starting in 2002. The dot-com bubble popped in March 2000, and the U.S. officially went into recession in March 2001. Enron was exposed as a massive fraud and went bust in December 2001 in the largest bankruptcy in U.S. history up until then. WorldCom collapsed for similar reasons a few months later, in an even larger bankruptcy. The NASDAQ crash, compounded by corporate scandals that exposed deep failures in U.S. accounting oversight, shattered investor confidence and led many to sell dollar-denominated assets, putting downward pressure on the dollar. The Fed began cutting the federal funds rate in July 2000 from 6.9%. and continued cutting rates very sharply throughout 2001, bringing the federal funds rate all the way down to 1.5% by the end of that year, and eventually to 1% in December 2003. Normally, a rapid reduction in the federal funds rate would have pulled down the value of the dollar, but the dollar index peaked in February 2002, well after the corporate scandals and the Fed's rate cuts. It's quite surprising that the dollar held up that long. One reason it did is because of the flight to safety into dollars following the 9/11 attack on the U.S. in September 2001. But once the dollar began to fall, it lost value quickly. By September 2002, it was down 11%. The surging U.S. current account deficit set a new all-time high of 5% of GDP in 2004 at $636 billion. Investors began to question the sustainability of such a large imbalance. Those doubts also contributed to reduced demand for dollar assets. My concern that the huge U.S. current account deficit was destabilizing the global economy was the reason I wrote my first book, The Dollar Crisis. It was completed in September 2002. Since then, the dollar has lost 91% of its value relative to gold. As mentioned above, by December 2004, the dollar index was down 33% from its February 2002 high. That was the first stage of the dollar crash. The dollar index rebounded during 2005, back to 91 in December, but the crash resumed in 2006. In the second stage of the crash, the dollar index fell to a low of 71 in April 2008, a 22% drop from December 2005, and a 41% drop from the February 2002 high. The second stage of the dollar crash was caused by new and even more serious economic and financial concerns. By 2006, it became clear that the U.S. housing market was overheating. In 2007, the subprime mortgage crisis began, with rising defaults and falling home prices. Investors lost confidence in U.S. financial institutions and the broader U.S. economy. As the crisis deepened in 2007 and 2000,